Okay, let's unpack this. Imagine a company, maybe one that's struggling a bit, and lots of big-time investors are looking at it thinking, this stock, it's going down.
Right, they're making a bet, a big bet, not on the company, but against it.
Exactly. They're putting serious money down, betting the price will fall. But then, what happens if a whole crowd of other people notices just how many are betting against it?
And they decide to flip the script.
Yeah. Suddenly the price doesn't just edge up, it rockets, it goes vertical. And those folks who bet against it, they're facing potentially catastrophic losses.
That collision, that intense market-shaking moment.
Yeah.
That's really the heart of what happens when high short interest meets unexpected buying pressure. It's dramatic.
It really is. It's one of the most dynamic and frankly riskiest parts of the financial markets. Short selling itself, betting on a price drop, it has a role, right?
Oh, definitely.
Right.
It's considered a necessary function for market efficiency, price discovery.
But when a stock gets heavily shorted, it creates this hair trigger situation, a volatility trigger, unlike almost anything else.
Precisely. And that's what we're diving into today. We're going beyond just defining short selling. We want to explore what it really signifies when a stock shows high short interest.
Like, what are the actual mechanics? What's going on under the hood in this high-stakes gamble?
And what forces get unleashed when this kind of bet goes spectacularly wrong for the short sellers, or right for others. We'll definitely look at, well, the example everyone remembers.
The one that took short squeeze from Wall Street jargon and blasted it onto front pages everywhere.
Exactly. And our sources for this deep dive give us a pretty wide view. We've got material covering the basics of short selling, the nuts and bolts of short interest itself, and of course, the short squeeze phenomenon.
We've also looked closely at the GameStop saga, pulling from analyses of that specific wild event.
And this is quite interesting. We found an analysis that asks a really fundamental question. Why are the biggest players, the huge institutional investors, mostly not directly involved in widespread short selling, despite potential upsides?
That is surprising. You'd think they'd be all over it.
Right. So our mission today is to connect all these pieces for you. We want to break down the risks, the rewards of betting against a stock.
Understand that unique force, the short squeeze. See how it played out in the real world with GameStop.
And then figure out who is and who isn't playing this game in the modern market, and importantly, why.
Okay, let's dive deep into the mechanics, the drama, and the hidden complexities of short interest. Where should we start? The basics.
Let's start right there. The fundamental mechanism. How do you actually make money if you think a stock's price is going down? What is short selling?
Okay, walk us through it.
So at its heart, short selling is a bet that a stock price will fall. To make this bet, you first need to borrow shares of that company.
Borrow them? From who?
Usually from a broker. The broker holds shares for lots of different investors, and they facilitate lending them out for a fee, of course. So you borrow shares you don't actually own.
Okay, step one, borrow shares. Got it.
Step two, you immediately sell those borrowed shares on the open market at whatever the current price is.
So now you have cash from the sale.
Exactly. But you also have an IOU. You owe those shares back to the person or entity you borrowed them from at some point down the line.
And the whole idea, the hope, is that between selling them now and needing to return them later, the price drops.
That's the core bet. If the price does fall, say from $50 down to $30, you can then go back into the market and buy the same number of shares you owe, but now at the lower $30 price.
Ah, okay. So you buy them back cheaper.
Right. That act of buying the shares to return them is called covering your short position.
So you sold high, bought low to cover. Makes sense.
And once you bought them back at the lower price, you return those shares to the original lender. Your profit is the difference between where you sold $50 and where you bought back $30 minus any costs.
Okay, fundamental process clear, but I can immediately see the flip side, the risk. What if you're wrong? What if the price goes up instead of down?
And this is the absolute crucial difference. It's what makes short selling fundamentally riskier, arguably, than just buying a stock. When you buy a stock, we call it taking a long position. Your potential loss is limited. If you buy a stock at $50 a share, what's the worst that can happen?
It goes to zero. You lose your $50 per share.
Exactly. Your loss is capped at your initial investment. You can't lose more than you put in.
Yeah.
With short selling, it's completely different. The potential for loss is, theoretically, unlimited.
Unlimited? How?
Think about it. You short sell at $50. The price goes up to $100. To cover, you now have to buy back at $100 shares you sold for $50. You've lost $50 per share.
Okay, that's bad.
But what if it goes to $200? Now you've lost $150 per share. What if it goes to $500? You've lost $450 per share. There's no theoretical ceiling on how high a stock price can go.
Oh, wow. So if you're wrong, your losses just keep climbing and climbing. There's no upper limit.
Precisely. Unlimited potential loss.
Yikes. That sounds incredibly dangerous, especially when you consider that generally the market tends to go up over the long term, right?
That's another key point. Short sellers are inherently betting against that general upward trend, which makes it a statistically challenging game even before things go wrong. And it's not just the unlimited downside risk.
There are costs too.
Oh yes, you pay fees to borrow the shares. Those fees can get really high if the stock is already heavily shorted and hard to find lenders for. You have to post collateral, basically a security deposit.
Yeah.
You have to maintain a certain level of equity in your account called margin. If the stock moves against you, you might get a margin call forcing you to either put up more money or close your position at a loss. And then there are regulatory requirements.
So it's not just betting on a price drop. You're paying for the privilege, you're fighting the market's general direction, and you have this potentially infinite risk hanging over you.
It's a tough game, which leads us to how we actually measure these bets against a company. This is where short interest comes in.
Right. What exactly does that term mean?
Short interest is simply the total number of shares of a given company that have been sold short by all investors, but haven't yet been bought back or covered.
So it's like the total outstanding balance of all the short bets currently active on that stock.
Exactly. It tells you the raw number of shares that someone out there needs to buy back eventually.
Okay. And I've heard of the short interest ratio too. How is that different?
Yeah, a ratio, sometimes called the days to cover ratio, is often more useful for traders. You calculate it by taking that total short interest number.
The total shares shorted.
And dividing it by the stock's average daily trading volume, typically over the last month or so, maybe 30 trading days.
Okay, so total shares shorted divided by how many shares usually trade each day. What does that tell you?
It gives you an estimate of how many days, based on recent trading activity, it would theoretically take for all the short sellers to buy back the shares they owe if they all decided to cover around the same time.
Ah, so it's a measure of potential buying pressure relative to normal liquidity.
Precisely. It's a measure of how crowded the short trade might be and how difficult it could be for shorts to get out if things turn against them quickly. Traders, both fundamental and technical analysts, watch this ratio closely.
As a sentiment indicator.
Yes. A high days to cover ratio, you often hear numbers like 5 days or more cited, is generally seen as a bearish signal for that stock. It means a lot of people are betting against it, and it could take them a significant amount of time to unwind those bets if they needed to.
That makes sense. I've also seen short interest talked about as a percentage, like percentage of outstanding shares.
Good point. That's another common way to look at it. You just divide the total shares sold short by the total number of shares the company's issued.
So what proportion of the whole company is being bet against?
Right. Or sometimes it's calculated against the public float, which is the shares readily available for trading, excluding shares held by insiders or governments that aren't typically traded.
How do the ratio and the percentage compare? Which is more important?
They tell you slightly different things. The percentage gives you the scale of the short bet relative to the company's size. The ratio, the days to cover, adds the dimension of liquidity or trading activity.
Ah, okay.
You can have a high percentage of shares shorted, but if the stock trades, say, tens of millions of shares every day, maybe those shorts can cover relatively easily if needed. But if you have that same high percentage shorted in a stock that barely trades, say only a few thousand shares a day,
then the days to cover ratio would be huge. It would take ages for them to buy back shares without massively moving the price.
Exactly. The ratio really highlights the potential bottleneck, the difficulty and time it might take to unwind those positions, which is critical context for understanding squeeze potential.
And that potential difficulty, that scramble to buy back shares when things go wrong for the shorts. That's the trigger for a short squeeze, isn't it?
That's precisely it. When a stock is heavily shorted, meaning high short interest, often a high days to cover ratio, and its price starts to rise unexpectedly, maybe due to good news or maybe just buying pressure, that can kick off this powerful chain reaction, the short squeeze, or sometimes called a bear squeeze.
Why squeeze? What's happening to the short sellers? Feels like a good word for it.
Because they literally get squeezed. As the price goes up, their losses mount. Remember that unlimited risk? It starts becoming very real, very fast.
Well, they start losing money rapidly.
Right. to stop the bleeding, or because their broker issues a margin call demanding more collateral, they are forced to buy shares in the open market to close out their positions. They have to cover.
But wait, if they're forced to buy, wouldn't that push the price up even more?
Bingo, that's the feedback loop. Their forced buying adds more demand for the stock, driving the price higher still.
Which makes things even worse for the short sellers who haven't covered yet.
Exactly. It forces more shorts to cover, adding more buying pressure, pushing the price up even faster. It becomes this vicious, self-reinforcing cycle for the shorts. The price can absolutely explode upwards in a very short time, often way beyond what the company's actual business fundamentals would justify.
Wow. So it's like a panic fueled by forced buying. This isn't just theory, right? It actually happens. I think you mentioned Volkswagen earlier.
Oh, absolutely it happens. Volkswagen in 2008 is a classic, if slightly older example. For a brief, very strange moment, VW actually became the most valuable company in the world by market cap.
How?
Largely due to a massive short squeeze. Many investors had bet against VW. But then Porsche, which already owned a chunk, made a surprise announcement. They revealed they'd secretly gained control through options of a much larger stake in VW than anyone realized, and planned to increase it further.
So the shorts were caught completely off guard. They thought the stock might drift down, and suddenly a huge buyer essentially cornered the market.
Pretty much. Porsche's announcement effectively revealed that the number of shares actually available for short sellers to buy back the free float had shrunk dramatically and unexpectedly.
Panic time for the shorts.
Complete panic. Realizing the supply of shares to cover with was suddenly tiny, combined with Porsche's own buying, triggered a desperate scramble among shorts to buy back shares at almost any price. The stock price went parabolic.
Incredible. The winners and losers in that must have been stark.
Extremely stark.
Yeah.
Devastating losses for the short sellers, potentially wiping out entire funds. Conversely, phenomenal life-changing gains for those who own VW shares or traders who anticipated or jumped on the squeeze quickly. It really shows the extreme wealth transfer that can happen in these events.
Which brings us inevitably to the saga that really put this whole concept on the map for everyone. GameStop. That felt like, well, more than just a stock going up. It felt like a cultural moment.
It really did. It had all the elements. You had GameStop, the company itself, a brick-and-mortar retailer selling video games, facing, let's be honest, pretty significant headwinds.
Yeah, the world was moving to digital downloads, online sales. Tough spot for a physical store chain.
Exactly. And the numbers reflected that. Like, their holiday sales in 2019 were down sharply, over 27% year over year. Comparable store sales down almost 25%.
So from a traditional investment perspective, the outlook wasn't great, which made it a target for short sellers.
Precisely. A lot of professional investors, especially hedge funds, looked at GameStop's struggling business model and thought, this is a prime candidate for a short. They expected the price to keep falling.
And they bet big.
They bet very big. This led to an extraordinarily high level of short interest in GameStop. At its peak, the reported short interest was just staggering numbers. As high as 141% of the company's outstanding shares were being cited.
Wait, hang on. 141%.
Yeah.
How is that even possible? How can more shares be shorted than actually exist?
Yeah, it sounds mathematically impossible, doesn't it? But it can happen because of the mechanics of share lending. The same share can effectively be lent out, sold, relent, sold again, multiple times in a chain.
Can you walk me through that?
Sure. Imagine investor A owns a share and lends it via their broker to short seller B. Short seller B sells that share on the market to buyer C. Now, buyer C owns that share.
Okay.
But buyer C's broker might then lend that same share out to short seller D, who sells it to buyer E, and potentially so on. So that single original share is now underpinning multiple short positions simultaneously.
Ah, I see. So the total number of shares recorded as sold short can actually exceed the total number of shares the company originally issued because of this relending or rehypothecation.
Exactly. And that complex layering is what makes a stock exceptionally vulnerable to a massive squeeze if something triggers all those different short sellers needing to buy back shares at the same time. The demand can vastly outstrip the apparent supply.
Okay, so we have GameStop, struggling business, huge amount of institutional money betting against it, leading to this incredibly high layered short interest. What lit the fuse?
This is where the story pivots dramatically. A large community of individual investors, often called retail investors, using easy access online trading platforms, started noticing this extremely high short interest figure.
And they weren't seeing it just as a sign of weakness.
No, they saw it as a vulnerability. They coordinated and discussed their ideas primarily on social media, with the subreddit Our Wall Street Bets becoming the main hub.
Yes, Wall Street Bets, known for its unique culture and sometimes very aggressive trading ideas.
That's the place. Users there saw the massive short position not just as a reflection of GameStop's problems, but as a potential tripwire for the hedge funds involved. Their thinking was essentially, if we can band together and buy enough shares
Push the price up.
and force those heavily committed short sellers into a corner, making them buy back their shares at higher and higher prices, triggering the squeeze, basically weaponizing the short's own position against them.
Wow. And that community grew rapidly.
Explosively. Millions of new users joined the subreddit almost overnight. Things got so intense that the subreddit was briefly made private. Their associated Discord chat server was temporarily banned, though Discord later helped reinstate it. They had their own lingo, like calling stocks stunks, and rallied around certain figures.
Like Keith Gill, Roaring Kitty. He was a big part of this, wasn't he?
He was very prominent. Keith Gill had actually been posting his analysis arguing GameStop was undervalued on YouTube and Reddit for months before the major squeeze, focusing on things like its cash reserves and potential turnaround. His detailed posts and conviction gained a massive following within that retail community.
So he provided a sort of fundamental underpinning beyond just the squeeze idea, and they specifically targeted certain hedge funds.
Yes, the narrative quickly focused on funds known to have large short positions. Big names like Melvin Capital, founded by Gabe Plotkin, Citron Research, led by the well-known short seller Andrew Left, and D1 Capital became primary targets in the online discourse.
These were the giants they were trying to take down.
They were certainly the focus. Other major Wall Street figures got drawn in too, like Steve Cohen, whose firm Point72 had invested in Melvin, and veteran investor Leon Kuberman, who publicly criticized the retail trading frenzy.
So the battle lines were drawn. Organized retail investors, inspired by figures like Roaring Kitty, versus established Wall Street hedge funds. How did the squeeze actually play out? What was the mechanism?
The retail strategy wasn't just buying shares directly, though they did a lot of that. They also bought huge numbers of call options on GameStop stock.
Call options give you the right to buy the stock at a certain price later. How did that amplify things?
Well, think about who sells those options. Often it's large financial institutions, market makers. When retail investors bought tons of these call options, especially short-dated ones, the sellers of those options had to protect themselves against the risk of the stock price rising sharply.
How did they do that?
They hedged their position. A key way they do this is by buying the underlying stock itself. It's called delta hedging. So as GameStop's price started rising due to direct retail buying, the institutions who sold call options were also forced to buy GameStop shares to manage their own risk.
So the options buying created a second wave of forced buying, this time from the institutional side, like pouring gasoline on the fire.
Exactly. It acted as a massive accelerant. This combination, direct retail buying plus the forced institutional hedging from the options market, created an absolutely unprecedented surge in demand for GameStop shares.
And the price reaction
Was insane. Just completely explosive. GameStop's stock price went vertical in just a few days. The volatility was off the charts. Trading was halted multiple times on exchanges and by brokers because the price swings were so wild. At the absolute peak of the frenzy, it briefly touched over $500 a share in pre-market trading.
From what, like $20 just a few weeks earlier?
Something like that. It was a truly historic, chaotic period in the market, demonstrating the raw power of coordinated buying hitting a vulnerable, heavily shorted stock.
The aftermath must have been widespread. It wasn't just about one stock's price anymore.
Absolutely not. The consequences ripple outwards immediately. First and foremost, for the short sellers caught on the wrong side.
What happened to them? Melvin Capital, Citron.
The losses were devastating. Melvin Capital became the poster child. They reportedly lost 53% of their entire fund's value in January 2021 alone. They had to close out their GameStop short at a massive loss and needed a $2.75 billion bailout investment from Citadel and Point72 just to stay afloat.
Wow, 53% in 1 month.
And ultimately, the damage was too severe. Melvin Capital announced it was winding down and returning capital to investors in May 2022. It basically ceased to exist because of this event.
A major hedge fund gone. That's incredible.
It really underscores the potential severity. Citron Research, run by Andrew Left, after taking heavy losses and facing intense public backlash, announced they would stop publishing short-selling research altogether after 20 years in the business. D1 Capital reportedly lost about 20%. Many other funds faced similar pain, retreating or closing down.
And the impact wasn't just financial, right? There were personal threats, too.
Yes, that was a disturbing element. Reports emerged of intense online harassment targeting the individuals involved. Social media accounts hacked. threats against personal safety. Figures like Left, Plotkin, and Cohen reportedly had to hire extra security. It got very ugly and personal.
What about the other side, the retail investors? Was it a clear win for the little guy?
It's much more complicated than that simple narrative suggests. Yes, many who got in early and sold near the peak made significant profits, life-changing money for some. But the stock was incredibly volatile, and eventually the price crashed back down.
So lots of people who bought later got burned.
Absolutely. Many bought in near the top, caught up in the hype, and suffered huge losses when the price collapsed. This led to concerns from regulators. William Galvin, the Massachusetts Secretary of the Commonwealth, publicly worried about unsophisticated investors getting hurt by reckless speculation, even calling for a trading suspension.
But some argued it was a valuable lesson.
Yeah, figures like Kevin O'Leary framed it as positive real-world education, suggesting it would make hedge funds think twice about overly aggressive shorting. But alongside the success stories, there were definitely reports of substantial losses, even tragic stories like teenagers gambling away savings. There was even a widely circulated, though perhaps hard to verify, report about Michael Jordan losing a fortune on GameStop shorts.
Michael Jordan really shows how far the ripples spread.
It does. And it wasn't just investors feeling the heat. The brokers, especially Robinhood, found themselves in the eye of the storm.
Right. Robinhood was the platform many of these retail traders were using. What happened with them?
Amidst the peak volatility, Robinhood made the controversial decision to restrict trading in GameStop and several other meme stocks. They essentially only allowed users to sell their positions, not buy more or open new ones.
Why did they do that?
They cited reasons related to clearinghouse deposit requirements, which surged due to the extreme volume and volatility. Basically, the financial plumbing behind the trades required them to post much more collateral, and they claimed restricting buying was necessary to manage that risk.
But the reaction was furious, wasn't it?
Immense backlash. Users and many observers saw it as the system rigging the game, protecting the hedge funds by shutting down the buying pressure from retail. It felt like Wall Street pulling up the ladder.
I remember seeing protests.
Yes, protests outside their HQ, review bombing on app stores, Google had to intervene, just widespread outrage. And of course, lawsuits.
What came of the legal challenges?
Numerous class action lawsuits were filed, alleging the restrictions were unfair and harmed investors. A judge did eventually rule that Robinhood's customer agreement gave them the right to impose restrictions under extreme market conditions, dismissing some claims. However, the broader consolidated litigation related to those January 2021 events is actually still ongoing as of late 2024. The legal fight isn't over.
And did this phenomenon just stop with GameStop?
Oh no, not at all. GameStop kicked off a broader meme stock rally. Inspired by the success and the online coordination, retail traders started looking for other heavily shorted stocks to target.
Which ones?
Companies like AMC Entertainment, the movie theater chain, Bed Bath & Beyond, American Airlines, even defunct names like Blockbuster saw weird surges. Others included Virgin Galactic, Palantir, Kodak, Koss, the headphone maker, Nokia, Tootsie Roll. A whole basket of stocks with high short interest saw dramatic short-lived spikes.
It really spread like wildfire. Did it jump to other asset classes too?
It did seem to spill over. Cryptocurrencies, particularly Dogecoin and Bitcoin, saw huge pumps, partly fueled by the general speculative mania and attention from figures like Elon Musk. Even commodities weren't immune. Silver futures saw a rapid surge.
Was that also Wall Street bets?
Interestingly, users on the forum largely denied orchestrating the silver squeeze, with some even suggesting it might have been institutions like Citadel trying to cause a distraction or cover losses elsewhere. It got very messy and conspiratorial.
So the simple story of Reddit versus hedge funds really doesn't capture the full picture, does it? Who actually won in the end?
That's the crucial question, and the source material strongly suggests the narrative needs nuance. While retail traders were the visible force, many traditional Wall Street players and insiders benefited hugely.
How so?
While GameStop's own corporate executives reportedly sold millions of dollars worth of stock during the run-up, cashing in. Some hedge funds that were actually long GameStop, betting on it, made fortunes. Senvest Management reportedly made $700 million.
So hedge funds were on both sides.
Absolutely. And the really big institutional holders, like BlackRock, who held large passive stakes, potentially saw their holdings balloon in value by billions. One estimate suggested $2.4 billion for BlackRock alone. A Morgan Stanley fund also saw big gains.
So the established players did pretty well out of the chaos.
It seems so. Even entities like the Mormon Church's investment fund and the families behind some other meme stocks like COS reportedly profited significantly. Post-event analysis strongly suggested that the Wall Street elite, far from being uniformly defeated, actually benefited substantially overall from the volatility. Yeah. The little guy beats Wall Street story was, at best, incomplete.
And all this chaos obviously caught the eye of regulators and politicians. What was the official response?
It went right to the top very quickly. The White House said they were monitoring it. Treasury Secretary Janet Yellen called an urgent meeting with the heads of the SEC, the Federal Reserve, and other key financial regulators to discuss the volatility.
What did the regulators say they'd do?
The SEC put out statements saying they were reviewing the situation, committed to protecting retail investors, and would investigate any potential market manipulation or abusive practices.
Did Congress step in?
Yes, multiple congressional hearings were held. They brought in the CEOs of Robinhood, Citadel, Melvin Capital, even Keith Gill, Roaring Kitty himself, to testify. The focus was on understanding the market structure, the role of brokers, payment for order flow, and the sheer mechanics behind the trading frenzy.
Any concrete outcomes?
Lawsuits were filed against various participants, including Gill. The event definitely fueled discussions about things like a potential financial transaction tax. A congressional panel eventually released a report calling for regulatory crackdowns. And as we mentioned, the consolidated lawsuits are still working their way through the system. It was a catalyst for a lot of scrutiny.
It really feels like GameStop pulled back the curtain on some deep, complex, maybe even fragile parts of the market system that most people never see.
I think that's exactly right. It raised fundamental questions about market transparency, the influence of social media on trading, the power dynamics between retail and institutions in this digital age, and whether the underlying infrastructure could handle these kinds of modern, socially driven market events.
Okay, so given that backdrop, the sheer drama, the massive risks highlighted by GameStop, the potential for systemic disruption, it leads to a really interesting question you raised earlier. Why aren't the biggest players, the giant institutional investors, heavily involved in direct short selling?
Right. We're talking about insurance companies, banks, huge pension funds, university endowments, sovereign wealth funds, pools of capital that dwarf even the largest hedge funds. Yet the analysis we looked at points out they're largely absent from widespread direct short selling in public stocks. It's a surprisingly unexplored area in finance literature.
Why? What's holding them back? They have the money, the analysts.
It seems to be a combination of factors, deeply rooted in their structure, their specific mandates, and the different regulatory environments they each operate under.
Let's start with the basics. Is it just too costly or inherently difficult for them?
That's definitely part of it. As we discussed, shorting involves ongoing costs, borrowing fees, collateral requirements, margin calls, compliance overhead, and you're generally fighting the market's upward trend. For institutions focused on steady, long-term growth or guaranteeing payouts, actively paying to bet against the market might just be strategically unappealing on average.
Okay, so the basic economics are tough. What about rules and regulations? Are they just banned from doing it?
For some, yes, or heavily restricted. The rules vary a lot by institution type. Take insurance companies. Their regulation is all about solvency, making sure they can pay claims. State laws usually prohibit them from short selling unless it's a direct hedge against an asset they already own or are about to buy. Their investment options are very conservative. Speculative shorting is basically off the table.
Okay, so insurers are out due to safety regs. What about banks?
Banks face their own set of strict regulations, limiting what they can invest in for their own account. Insured banks are often flat out prohibited from holding equities, long or short. Plus, post-financial crisis rules require them to hold lots of super safe liquid assets, like government bonds, which ties up capital. While investment banks used to do more proprietary trading, including shorting, that's been significantly curtailed. So banks generally aren't players in direct equity shorting. It would require major legal and cultural shifts for them to get involved.
Strict barriers for banks and insurers. What about mutual funds? They manage vast sums for the public.
Mutual funds are where it gets more interesting and a bit puzzling. The main law governing them, the Investment Company Act of 1940, used to restrict leverage, but modern SEC interpretations generally allow short selling, as long as the fund sets aside liquid assets to cover 100% of the potential obligation.
So they can do it if they have the cash to back it up.
Yes, and they can also use derivatives like swaps or futures to get short exposure, sometimes with significant leverage, without facing the same direct shorting restrictions. So the formal regulatory barriers for mutual funds to short are actually much lower now than they used to be or compared to banks and insurers.
But are they actually doing it much? If they can, and it can be profitable?
That's the puzzle our source highlights. Despite the rules allowing it now, and despite some academic evidence suggesting funds that do short can achieve good returns, the overall volume of direct short selling by traditional mutual funds remains surprisingly low.
Why the disconnect?
It's not entirely clear. Maybe historical conservatism, maybe internal fund rules, though data shows most funds now permit shorting in their prospectuses, even if they don't do much of it. Perhaps concerns about principal agent issues managers might have different risk appetites than the fund's investors. It's an area where the permission seems to be there, but the widespread practice isn't, and the reasons aren't fully understood.
Okay, so a bit of a mystery with mutual funds. What about the really big long-term investors? Pension plans, university endowments.
These typically operate under what's called the prudent investor standard. This is a legal duty defined by state laws or federal law like ERISA for private pensions. It requires managers to invest with care, skill, and diligence, considering the portfolio as a whole. Importantly, these rules usually don't forbid specific types of investments outright, including shorting. The modern standard focuses on the overall process and portfolio risk, not banning asset classes.
So legally, under the prudent investor rule, they probably could short.
The statutes are broad enough to potentially allow it, yes. However, the source notes that courts haven't explicitly given a green light saying direct shorting, with its unlimited loss potential, always meets the prudent standard. Given the severe consequences for fiduciaries if they're found to have breached their duty by taking excessive risk, many likely play it safe and avoid significant direct shorting. They might fear legal challenges. The source even suggests clearer legal guidance might encourage more institutional shorting.
It sounds like a mix then. Hard regulatory walls for some, lingering conservatism for others, and maybe some legal ambiguity keeping these big traditional players mostly out of the direct shorting game. What about sovereign wealth funds? The giant national investment pools.
Sovereign wealth funds, SWFs, often have more flexibility. Their main goal is usually long-term return maximization, and they face fewer specific restrictions. However, many aren't very transparent about their holdings. Norway's fund, which is transparent, focuses mainly on long stocks and bonds. Interestingly, they use ethical exclusions to decide what not to buy, but they don't seem to use shorting as an ethical tool.
They don't short companies they deem unethical.
Not as a stated policy for those exclusions, according to the source. They did notoriously short Icelandic bank bonds back in 2008, anticipating the collapse, but faced political heat for it. So while SWFs could short equities more, they might be wary of the potential political fallout if they're seen betting against companies, especially foreign ones. Plus, many prefer a passive long-term investment style.
So direct shorting seems largely off limits or avoided by these major institutions, but they can still get exposure indirectly, can't they?
Oh, absolutely. And this seems to be the primary way they do participate in short-side strategies. They invest in other specialized funds.
Like allocating capital to hedge funds that do the shorting.
Exactly. Many endowments, like Harvard and Yale, famously invest in absolute return strategies run by hedge funds, which routinely use short positions and derivatives. Singapore's SWF reportedly allocates a significant chunk of its assets to hedge funds that engage in shorting. There are also specialized mutual funds, like bear market funds, designed specifically to profit from market declines using shorting.
So they effectively outsource the shorting activity to specialists who are structured to handle the complexities and risks.
That seems to be the dominant model. And this indirect approach is generally feasible for most institutions, even banks and insurers within their equity limits, without needing major rule changes, unless their own internal policies forbid it.
It's fascinating that despite these hurdles and the risks we saw with GameStop, the analysis argues that more institutional short selling could actually be good for the market overall.
That's a really crucial counterintuitive point. The core argument is that short selling plays a vital role in price accuracy and market efficiency. It helps get negative information into the market faster and more effectively.
How does that work?
Well, think about incentives. Companies have every reason to shout good news from the rooftops. It boosts the stock, makes execs look good, helps raise capital. But they have much less incentive to publicize bad news or reveal internal problems.
Right.
That usually hurts the price.
So there's an inherent bias towards positive information flow.
Exactly. Now, consider investors who only go long, they only buy stocks. If they uncover negative information about a company they own, what's their best move? Sell the stock to avoid a loss. But the potential gain from doing that research is limited to the size of their holding. If you own thousands of stocks in a diversified fund, spending huge resources to find bad news about one tiny holding just doesn't offer much payoff.
Right. The incentive isn't really there to actively dig for dirt on your own holdings.
Precisely.
Yeah.
Short selling flips the incentive structure. It creates a direct profit motive to actively seek out negative information. Find companies that are overvalued, potentially fraudulent, or facing serious undisclosed problems. If you short the stock, and you're right, you can profit significantly when the negative information comes out and the price drops. This is the explicit strategy of many activist short-selling hedge funds.
So shorting essentially pays people to be skeptical and do negative research.
You could put it that way. It provides a financial counterweight to the natural corporate tendency to only share good news. While companies will still lean positive, and shorting has its costs and limits, having enough short sellers active in the market helps ensure that negative information does get surfaced and reflected in the price more quickly.
Which leads to more accurate prices overall and better allocation of capital in the economy. Like, money flows away from weaker companies sooner.
That's the argument for its market efficiency role. Despite the drama and the negative perception it sometimes has, short selling arguably serves a vital function in keeping markets more honest and efficient. It's a corrective force.
Okay, moving on from the why and who, shorting also creates some real practical headaches in the market's plumbing, doesn't it? Because you're lending shares that someone else still technically owns title to.
It really does introduce complexity. Because shares are borrowed and then sold to someone else, it messes with basic shareholder rights, like voting and dividends.
How so? Who gets to vote?
Typically, when a share is loaned out, the voting rights travel with the share. So the buyer who purchased the share from the short seller gets the right to vote at shareholder meetings, not the original owner who lent it out.
So the original owner loses their vote while the share is on loan?
Generally, yes. And dividends work similarly. The actual cash dividend paid by the company goes to the current holder of the share, the buyer. The short seller then owes the original lender a payment equivalent to that dividend amount.
A payment in lieu of the dividend, does that cause problems?
It can. These payments might be taxed differently than regular qualified dividends, which can be disadvantageous for the lender. It adds transaction costs and raises fairness questions. It just makes tracking who gets what more complicated.
Sounds like a potential nightmare to track, especially with high-speed trading. And what about new tech, like blockchain? Could that help or hurt?
That's a really interesting question the source touches on. Blockchain promises greater transparency in tracking assets. You might think that would simplify things.
But maybe not.
It could actually make things more complex for share lending and shorting. If every share is uniquely traceable on a ledger and has been lent out multiple times, the original owner might become much more aware of exactly where their share is.
And they might want it back.
Exactly. Especially if there's an important vote or corporate action coming up, blockchain awareness might lead original owners to try and call back their specific traceable share.
Which could unravel the lending chain and force shorts to cover unexpectedly.
Potentially. It could create instability if specific shares are recalled. However, there are huge practical challenges. How do you efficiently recall one specific share out of millions being traded at high frequency? Can the ledger keep up without delays that could be exploited? Some even argue a centralized instant auction system might be better than a distributed ledger for managing these complexities.
It's fascinating. Technology aimed at clarity might actually introduce new friction into this already complex system.
It really highlights how technology interacts with established financial structures in ways we might not anticipate. And the big institutions involved in both lending shares and potentially investing in short strategies have a real stake in figuring out the best way forward for this market infrastructure.
Okay, one last area the source touched on was the potential intersection of shorting and public policy engagement. How does that work?
Right. So traditionally, when large institutions, especially those with ethical or social mandates like endowments, public pensions, social responsible funds, want to make a statement or influence policy through their investments, they do it via their long positions.
Meaning they decide what not to own.
Exactly. They engage in divestment, selling off shares of companies involved in activities they object to, like tobacco, weapons, or fossil fuels. We've seen major institutions like Harvard, CalPERS, big insurers like Allianz, divest from coal, for example. They express their stance by refusing to hold the stock.
Okay, that's the standard approach. How does shorting fit in?
Short selling offers a way to take an even stronger stance against those companies. Instead of just not owning them, you actively bet against them by selling shares you don't own. It signals a much greater level of disapproval.
And unlike divestment, which just avoids losses if the company declines, shorting could actually let them profit from that decline.
That's the crucial difference. If an institution shorts, say, a fossil fuel company, because they believe climate policy will make it less valuable, they stand to profit if they're right. Divestment only avoids future losses. Shorting offers potential gains aligned with their policy view. Socially responsible funds could theoretically short vice stocks, for example.
That opens up a whole can of worms, doesn't it? Ethically and politically.
It absolutely does. The source raises this normative question. Is it actually desirable for these powerful institutions to use short selling to push their policy agendas? What if their goals aren't aligned with the broader public interest? Could they be tempted to advocate for policies specifically designed to hurt companies they've shorted?
Like lobbying for regulations just to profit from their short position.
Precisely. It raises serious questions about potential conflicts of interest and the proper role of financial institutions in influencing policy beyond just maximizing returns. But in an era of increasing focus on ESG and stakeholder capitalism, the idea of using all available financial tools, including shorting, to back institutional convictions is definitely part of the conversation.
Wow. Okay, this has been a really comprehensive look at short interest. We've gone from the basic mechanics and the huge risks
That unlimited loss potential. Yeah.
to the explosive dynamics of a short squeeze, using GameStop as the incredibly vivid, almost unbelievable case study, showing all the winners, losers, and the chaos it caused.
And then we explored that fascinating puzzle of why the really big institutional players mostly stay away from direct shorting the regulations, the caution, the legal gray areas, while still accessing it indirectly.
We also highlighted the crucial, if maybe underappreciated role short selling can play in market efficiency, acting as that counterbalance, bringing negative information to light for better price discovery.
Even if it's controversial sometimes.
Definitely. And we touched on the tricky plumbing issues it creates for voting and dividends, how new tech like blockchain might complicate things further, and even its potential debated role in policy debates.
It really shows that short interest isn't just a number on a screen. It's plugged into the deepest workings of the market.
Absolutely. It reveals so much about market structure, who has power, how information flows or doesn't flow, the impact of regulation, technology, even crowd psychology. It proves market prices aren't just about company fundamentals.
Far from it. Understanding this piece helps you see the whole system more clearly, all the complex forces at play.
So maybe the thought to leave everyone with is this. We see this tension, right? On one hand, short selling can help make markets more efficient by rewarding the discovery of negative truths. On the other hand, as GameStop showed, high short interest can fuel incredible volatility, risk, and social disruption.
A real double-edged sword.
So, thinking about that balance, what does it tell us about how our modern markets are evolving? And maybe more importantly, who should have the power to make these high-stakes bets against companies? And are the rules and the infrastructure we have now really up to managing the kinds of forces that short interest can unleash in today's hyper-connected world?
Really important questions to ponder as the financial landscape keeps changing.
Keep thinking, keep questioning, and stay informed. Thanks for joining us on this deep dive.
See you next time.